Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about EDISON International quarterly report. EDISON International provides a wide range of businesses and services to various sectors across Southern California. The company's offerings include electric power generation, distribution of electric power through its extensive infrastructure services to residential customers, commercial sector support, industrial sector, supply public authorities, assistance agricultural sector services, other specialized services. The company's distribution network includes transmission and distribution substations, overhead lines, underground lines, and electrical infrastructure maintenance. EDISON International's stock price drop. A year of challenges. In the past year, EDISON International's stock price has plummeted by over 29.74% due to a combination of factors. The primary concerns include wildfire-related liabilities, regulatory and legal challenges, and disappointing earnings reports. Wildfires in California have been a major source of uncertainty for investors, with ongoing concerns about potential liabilities and the long-term solvency of the Wildfire Insurance Fund. A class action lawsuit alleging inadequate disclosures about fire risks further added to the company's financial and reputational challenges. Analyst downgrades, such as Wolfe Research's downgrade from outperform to peer perform, also contributed to the stock drop. EDISON International's second quarter earnings miss, with an EPS of $0.97 against an expected $1.28, was another significant factor. Higher interest expenses at the parent company level and exclusion from the Russell 1000 Value Defensive Index further exacerbated the decline. While recent positive developments, including a strong third-quarter earnings beat and confirmation that the Eaton fire is a covered wildfire, aim to mitigate ongoing challenges, they occurred after the period of significant stock decline. These factors collectively contributed to EDISON International's notable stock price drop in the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the 2025 General Rate Case, GRC, final decision, which resulted in a $327 million increase in core earnings and an additional $880 million in authorized revenue requirement. The TKM settlement agreement also contributed to revenue growth through cost recoveries and claim costs. Additionally, higher pass-through costs led to increased operating revenue. On the other hand, revenue decline is primarily attributed to higher interest expense at EDISON International Parent and other, as well as impairment of incremental restoration-related assets. Amortization of SCE's contributions to the Wildfire Insurance Fund also contributed to decline in revenue. Furthermore, decrease in operating expenses due to lower operation and maintenance expense, purchased power and fuel expense, and income tax expense also led to a decline in revenue. Net income and profit margins. A significant improvement in 2025. The financial performance of a company has shown significant improvement in 2025 compared to the previous year. Net income increased by 130% from $1,319 million in 2024 to $3,036 million in 2025. This substantial growth can be attributed to cost recoveries authorized under the TKM settlement agreement and higher revenue from the 2025 GRC final decision. Profit margins have also seen a notable improvement. Operating income margin increased from 16.2% in 2024 to 31.2% in 2025, while net income margin rose from 10% to 21.6%. These significant increases indicate that the company has become more efficient and effective in generating revenue. The reasons behind this improvement are multifaceted. The cost recoveries authorized under the TKM settlement agreement have contributed significantly to the increase in net income. Additionally, higher revenue from the 2025 GRC final decision has also played a crucial role. Overall, these factors have led to a substantial improvement in both net income and profit margins, making 2025 a remarkable year for the company's financial performance. The company is indeed generating positive operating cash flow. This is evident from two key pieces of information. A direct statement on page 27 confirming this trend, and financial data on page 40 showing net cash provided by operating activities increasing to $4,455 million in 2025 compared to $4,037 million in 2024. Management's outlook and strategy. The company expects significant revenue growth driven by rate increases and increased demand. To achieve this, management plans to invest $29.3 billion in capital expenditures from 2025-2028, with additional investments totaling at least $2 billion. This investment is expected to drive long-term growth, improve customer satisfaction, and mitigate damage from wildfires. The company aims to fund its net cash requirements through a combination of cash on hand, dividends from SCE, and capital market and bank financings. Management intends to maintain a target payout ratio of 45%-55% of SCE's core earnings, while ensuring access to the bank and capital markets is maintained. The company's financial transactions include divestitures totaling approximately $532 million. This amount consists of waived uninsured claims and related financing costs under the SCD agreement, valued at $375 million pre-ob 1,054 losses waived in the Woolsey Settlement Agreement, valued at $157 million. EDISON International's financial update: the company has made significant investments in its shareholders through both dividend payments and share repurchases. Notably, EDISON International paid out substantial dividends to its shareholders, with a total payout of $1.29 billion for the 9 months ended September 30, 2025. In addition to dividend payments, the company also engaged in share buybacks under its 2025 repurchase program. A total of 549,779 shares were repurchased and retired during this period, utilizing up to $75 million of the program's allocated funds. This strategic move demonstrates the company's commitment to returning value to its shareholders while also maintaining flexibility for future investments. There are concerns about inventory buildup and supply chain disruption. An increase in accounts payable suggests potential issues with suppliers or cash flow management. Although the slight decrease in inventory is not alarming on its own, combined with rising accounts payable, it may indicate some supply chain disruption. That concludes the financial summary for EDISON International. Feel free to comment below, and I will be happy to answer them when possible.